This is Michael King, and today we're going to talk about crowdfunding and online lending. Crowdfunding is the process of raising money from individuals known as the crowd who each contribute a small amount. Crowdfunding happens through digital portals online and is a way for both individuals and small businesses to raise funding in the form of donations, rewards, equity, or loans. A platform used by a crowdfunding portal describes the technology or the infrastructure which they use to build their marketplace. There are two different types of crowdfunding. All or nothing crowdfunding, where the money is only collected if the campaign meets its funding target, and keep it all crowdfunding, where any money pledged is passed to the campaign sponsor. While crowdfunding has been around for decades, it really got its start in 2003 when Artist Share started raising money for recording artists. When it comes to fintechs, we saw Zopa out of the UK start a peer-to-peer lender in 2005, quickly followed by On Deck, Prosper in the United States, Lending Club, Indiegogo, GoFundMe, Cabbage, and Kickstarter. Crowdfunding is seen as a very disruptive business model for traditional financial intermediaries. It replaces the need for financial intermediaries and provides a way for small businesses and individuals to raise money quickly, which has led Goldman Sachs to call it potentially one of the most disruptive of all the new models in finance. Here you can see different types of crowdfunding. We have equity or profitability-based crowdfunding, which involves the sale of shares or claims on financial assets. We have donation or rewards-based crowdfunding, where individuals make donations with no obligation to the recipients, or they prepay for the development of products or services that will be provided later. Online lending is a way for individuals to raise loans or for businesses to take out loans, either from individuals or from institutions. Peer-to-peer refers to loans taken out from retail or small investors, whereas marketplace refers to institutional investors in addition to retail. A third model of online lending is balance sheet, where a bank or other financial intermediary will use the platform to source loans that remain on its balance sheet. Although not covered in this chapter, there are many different types of capital markets related fintechs which we will not be discussing. Initial coin offerings, for example, is a way to raise money through the sale of a cryptocurrency, or an initial token offering is a way to raise capital for a future product or service. Crowdfunding has grown to $418 billion by 2017, the vast majority of which has come from China, where peer-to-peer lenders are very large. It may surprise you to know that China's crowdfunding platforms are 8 times larger than the US. Looking more closely at North American crowdfunding types, we can see that balance sheet lenders and peer-to-peer and marketplace lenders make up the vast majority of volumes, with profit sharing and equity making up 5.5% and donation and rewards only 2%. So where does crowdfunding fit in? Well, from an equity point of view, crowdfunding is a way for founders of companies to raise money at an early stage, which would alternatively come from the founders, family, and their friends, angels, or potentially venture capitalists. You can crowdfund for either equity and debt, which would correspond to early and later stage rounds of funding, known as Series A, B, C, or mezzanine funding. Let's take a look at how you would run a crowdfunding campaign on the rewards platform Kickstarter, which funds artistic projects. Kickstarter's motto is to bring creative projects to life, and since it was founded in 2009, 18 million people have pledged $5 billion, of which 186,000 projects were successful. Kickstarter is an all-or-nothing crowdfunding website, and only 38% of projects have been successfully funded. To run a campaign, you set a funding goal, you set up a period over which you will collect the money, known as the funding period, you create a project page, you post a video and a description of the reward that your backers will receive. Kickstarter has certain rules for what is allowed. There is no fundraising for charities, equity, or other revenue sharing incentives. Most crowdfunding platforms follow what is called a multi-sided platform. On the left, we see a traditional financial intermediary as a one-sided business raising money from depositors or savers and passing it to corporations. With a marketplace lender, you have lenders and borrowers on either side. The platform earns fees from charging both sides. This multi-sided platform seeks to create economies of scale and network effects on the same side and across the platform. This is the business model used by e-commerce and technology companies, including Alibaba, Amazon, and others. There are many different types of fees that are charged by a crowdfunding or online lending platform. As you can see, on one side you have issuers or borrowers, on the other side you have investors or lenders, and there may even be third parties, either advertisers or balance sheet lenders. Issuers or borrowers are charged sign-up and subscription fees, although the major source of funding is an underwriting or an origination fee of 2 to 5%. This compares to a standard fee for an IPO of 7% of proceeds. There are also processing and late fees. From the investor or the lender side, they will be charged a management fee as well as other fees for transactions and servicing. And if the platform is also investing in the project, there may be a carry percentage. When it comes to acting as a platform for third parties, there may be commissions, advertising, and other servicing fees. Here you can see a description of some of these fees as outlined by the National Crowdfunding and Fintech Association of Canada. As an investor or a lender on a crowdfunding platform, there are many risks to be aware of. Investments are speculative with very low liquidity and little opportunity to back out once you make the investment. It is very hard to determine a valuation for these private and illiquid assets or companies. There is limited disclosure and always the possibility of fraud. Many companies that might otherwise receive professional advice from their early stage investors, either angels or venture capitalists, will not be receiving this through a crowdfunding platform where many individuals commit small amounts and do not advise the company. So you may be wondering if crowdfunding is a good investment. While a number of lending and a few crowdfunding platforms have gone public through initial public offerings in the United States. In this chart, we see the first year performance since IPO for a number of Chinese, American, and an Australian borrower. As you can see, these businesses have underperformed the market, and within a year, all of the ones shown have actually fallen below their initial IPO price. For example, you can see the yellow line, which represents Lending Club, which is down to 60% of its IPO value. Let's take a closer look. Lending Club was founded in 2007 and IPO'd in 2014 at $15. Its current share price is only $5.64. Despite being one of the largest peer-to-peer lending platforms, Lending Club continues to show losses despite a growth in revenue and a decline in leverage. You can see that the net margin for 2019 was minus 4%, which marks an improvement over the past 4 years when it was as high as minus 29%. Notice that Lending Club's expenses are very high, pointing to the cost of customer acquisition, which leads to very high marketing and advertising costs. These online platforms have to be structured in such a way that they comply with regulatory restrictions affecting banks. In the case of Lending Club and Prosper, they both work with a third-party web bank based out of Utah, which actually serves as their back office, meeting all of their regulatory restrictions. The borrowers will actually issue notes that are held by the partner bank, who then passes the note to Lending Club, where it then goes to the investors. Cash flows back through Lending Club's platform to the partner bank before going to the borrower. The platform receives a transaction fee, but then pays WebBank a fee for services. One of the key benefits of an online lender is that the application can take only 10 minutes and the borrower can receive funding in 1 to 2 weeks. Although it may appear to be an unregulated business, platforms that provide both crowdfunding as well as online lending face a number of different regulatory restrictions, typically on the side of the investors or lenders. These regulations are designed to protect non-accredited retail investors who may not understand the risks in this business. Portals also have to meet many registration restrictions. Here we can see, for example, the different categories of restrictions, and in Canada they have to register in individual provinces. So who borrows from a peer-to-peer lending platform? Well, it tends predominantly to be individuals or small businesses. Individuals may be refinancing credit card debt, paying medical bills that were unexpected, or financing renovations. Small businesses may be trying to finance working capital or raising cash for their day-to-day operations. The key value proposition is to apply online 24/7 using a simple application and receiving a fast decision with quick access to capital less than 2 weeks, as opposed to a bank loan which could take 4 to 6 weeks or more. This business has grown since the end of the global financial crisis, as people lost trust with traditional financial intermediaries and were willing to try new online lenders. The key takeaway is that crowdfunding platforms provide a way to raise money for business and individuals quickly and rapidly. There are many different types of fees, but due to high operating costs, particularly the cost of customer acquisition, many of these portals are not necessarily profitable. Individual investors, whether lenders or investors in equity, should be aware of the many risks involved in crowdfunding, including illiquidity, low disclosure, and the risk of fraud. That's it. Thank you for your attention.